Marty, can you talk about what is currently causing volatility in the market?
Yeah, no, I'd be happy to share my perspective, and thanks for kicking us off here today, Erica. I think honestly there's a number of things, which there always is in the market, but today I think there's three big ones. So first and foremost, the contributor is the Fed, and Fed policy around both monetary policy and interest rates. So we're coming off of one of the biggest government market interventions, in the history of our country and quite frankly of the world. So over the past 24 months, we've literally seen, trillions of dollars of stimulus. And, when you just stop and pause for a minute, a trillion is such a large number that I'm convinced most of us, as humans, it's really difficult to comprehend. So when you talk about multiple trillions being infused multiple times, it definitely moves the dial on the economy, both domestically for the U.S. and candidly worldwide. So the government has essentially flooded the economy with stimulus, made interest rates essentially zero, which means there's no cost of money whatsoever. And those two things combined have essentially just fueled the markets. And you can think of this like any type of fire or something that's burning. The more fuel you throw at it, the more oxygen it gets, the hotter it's going to burn, the stronger the flames are going to be. But that's for a period of time until either that fuel burns out or that fuel is removed. And quite frankly, that's where we're at today. So the Fed is pulling back on the amount of stimulus. Rates are actively being increased. And so those things make money tighter. It makes it more expensive. It makes it less available. And that's what we're going through in the markets today. So we're seeing the markets respond to the unknown of how quickly the Fed is going to do that and to what degree. And then second, obviously in the news today, we've got a very large geopolitical event situation as investors eye, what's happening over in Russia with Russia and Ukraine. And once again, that creates a lot of uncertainty global. And we can't forget, which I don't think really any of us have, but we're still 2 years into a pandemic, and that has certainly created a number of issues, again, both domestically and globally, which will continue to create uncertainty in the economy abroad and in the economy locally. So those three factors combined cumulatively are a massive amount of uncertainty. And that's exactly what the market does not like. The more certain things are, the more predictability we have in the market. The less certain things are, the more volatility we have. So, and that's exactly where we're at today. We're at a high degree of uncertainty, and hence, for the first time in a long time, we're seeing a lot more volatility than what we're used to.
So what should investors do during market volatility?
Yeah, I think it's a great question. Oftentimes what we hear, what we read is really simplistic and in my mind, overly simplistic. So oftentimes we'll hear, just be patient, ride it out, stay the course, be a long-term hold investor, which again, those are simplistic. There are some good starting points, but there's really much more to it if an investor really wants to optimize their portfolio. And more specifically, I think investors in today's world and really for as long as we've been doing this over the past 3 decades, they need to be what I call right twice. And to do well in volatility, not just survive it, I think investors need to be right emotionally and strategically. And it's actually pretty rare I see investors getting both of these correct, even with very sophisticated investors that have tenure in the market.